So now we've decided that the market's going up. We've selected the sectors that we want to invest in, and we've even selected the stocks that we want to buy. So now it's time to buy. Now, one of the most important things in investing is the simple idiom, buy low, sell high. And this is where a lot of investor mistakes are made. So let's take a look at it. What happens very often is when we've decided to buy a stock, we watch it. And when you hear yourself saying, I want to watch a stock, realize that that's a mistake. Once we've chosen the stock, we need to step up to the plate and buy it. What we typically do is we want to watch it. So the stock starts to go up and we get excited. And then it goes up some more and we get more excited. And the more up it goes, the more excited it gets until we can't stand it anymore and we buy it. Well, it's already gone up. We've bought it too high. The exact opposite happens. We're bought a stock and we think that we're committed to it and it starts going down. And we say, oh my gosh, it's going down. And then it goes down more and we get more and more worried and more frantic. Fear takes over and what happens? We sell it. So what have we done? We've bought high and sold low. What's the rule? Buy low and sell high. Typical trading error. How do we avoid this? How do we avoid having our emotions get control of us? We need a strategy. We need a discipline. We need trading rules. So the first thing that we need to do is we need to determine how much is that stock going to go up. We've done our research. We've seen that they have profit momentum, higher profits in the future than they have now. When I pick a stock, I want to expect to make at least 40% on that stock within a year. If I don't have the fundamental facts to support a 40% move, I don't buy it. And there are plenty of stocks out there that could move 40% within the next year. So what I do is, let's say the stock is trading right now at 20, I set a target, a sell target at 28. That will give me a 40% profit. So the first thing to do is a sell target. The second thing we need to do is a buy range. And that keeps us from buying the stock too high, from getting too excited and buying it too high. Because if we liked it at 20, it goes to 22, now our profit is only 30%. Goes to 24, our profit is only 20%. And that's not enough. So we need to set our buy range. So is our buy range from 20 to 24? No, our buy range is from 16 to 24. Because if we liked it at 20, we're going to love it at 16. So we have our target price to sell and we have our buy range. The other thing we need to know is, what do we do in case of the stock going down? So if the stock goes down 10%, that's normal. Stocks fluctuate 10% all the time. You need to not worry if the stock goes up or down 10%, even up. Don't get too excited. It could go down 10% as well. So we're looking at nothing to do if the stock goes at 10. But if it goes down 20%, that's when we need to step up our research. Why is it down 20%? Is it short-term event? In that case, fine. We're going to get over that. In the long run, we're going to make money. If it's a long-term event, we need to sit and reevaluate and go back to the fundamentals and look at that stock. If the fundamentals have changed, we need to sell it. We need to get out of it because it wasn't the same as what we originally bought. If the stock goes down 30%, then we need to take action. And the reason is we're in this for the long run. So if it goes down 30%, there's either a problem with the stock or we need to buy more because we don't want to have that opportunity to lower our cost and let it go by. So it's very important, if the stock goes down 30%, to take action. We need to be able to move on that stock. The last discipline we need to look at is when to sell. Selling is how you make money on a stock, not buying, selling. It's very hard when a stock has gone way up to sell it, because usually at that point there's a lot of excitement about it. And other people are actually buying that stock when you're getting ready to buy. Don't get messed up in the madness. Stick to your original plan. If that stock is fully valued according to your fundamentals, then take your action and sell that stock. However, sometimes things change. They opened a new hot dog stand, and it's a better stock than it was when you bought it. So at that point, we can either raise our target price and continue with the stock, or we can sell half of it and then continue with the stock. And I recommend selling half, and the reason is that we don't want to be very overweighted in any one stock. And if it's gone up in value, you have a lot more money in that stock than you do in your other stocks. So sell half of it or get out when you get to your target price, and then decide if you've sold half to continue with your stock. So now that we've set up all of our trading ranges, we have our buy range, we have our target price, we're ready to go. Now it's time to execute. Now they call it execution in the market because it's a little bit scary, isn't it? We have to be decisive. We have to be brave. How do we buy our stock? Well, there's hundreds of different ways to place your stock order. You can place a limit order, a stop limit, a fill or kill, a market on close. Dozens of different ways to do it. I recommend, again, keep it simple. What we want to do is get in there and make a decision and buy the stock. Don't chase it. Don't try to get the lowest price, because you won't. Don't try to get the higher price, you won't. And don't use all those fancy gimmicks, because they will backfire on you many, many times. I can't tell you how many investors got obliterated on stop-loss orders in the crash of '87. Stay away from those things. Keep it simple. So how do you do it? With a market order. A market order is simply you get the next available best price. Your execution is instantaneous. You get what you get, and it's very, very simple and easy to place. Unless you have huge amounts of stocks that you are buying, a market order is typically the very best way to buy your stock. And don't buy at the open and don't buy at the close. Like I said, don't get mixed up with the madness. Go in after the market has calmed down about an hour into trading. That's when you make your move. Or if you want to go to the end of the day, don't wait for the last hour. Go in the afternoon when it's calm, when you can see what's happening with the market. Very important. So, this is your portfolio. It's very important that you watch your stocks. This is your treasure chest. This is your wealth. This is your future. The more you know your stocks, the better. And you know what? All this research you're doing, it's going to be very interesting to you. You're going to become the best conversationalist you know. You are absolutely going to become the most interesting person in the room. You're going to get a lot smarter. You need to watch the headlines every day. See if your stock's in the headline. If it is, take a look at it. Don't look at the price action every day. Again, it'll drive you crazy. Look at it about once a week. Realize 10% fluctuation is totally normal. We're in this for the long run. And research your stocks. Look at your earnings about once a month at the minimum. Twice a month in some cases. This is a discipline. that we have to manage your treasure chest. And these are the things that we need to do to make money. We've opened a brokerage account with a discount firm. I recommend look for the lowest trading costs you can pay without getting into one of those trading deals where you have to trade 100 times to get the low price. Don't do that. Get the lowest costs you can get. Don't pay account fees. Use all the resources that's at your firm. Learn how to use the website. Learn how to use the trading tools. And then sit back and build your portfolio of gems. Learn as much as you can. Be committed to your investment. And realize this is going to be fun for you. This seminar is just the beginning. This just gives you an outline. It's very, very simple, but you do have a lot of work to do. This is my great-grandfather. He was the first investor on Wall Street that got us involved in this business 4 generations ago. His name was Leonore F. Lurie. Although I didn't know him, he taught me a lot about this. And, you know, I believe that an investment in the stock market, if everyone did it, we would have a much stronger economy. First of all, the wealth would be better distributed, because if you're getting 8 or 9% on your investments, you're going to be much better off in the long run, aren't you, than getting 4%. The markets would be more fair and balanced without all of this derivative trading and all of that nonsense going on. And U.S. businesses would greatly benefit from your investment. If we all got involved in buying stocks, it would be very good for our future and for our country. So I am happy to be on this journey with you. Thank you so much for joining us. And I want to also say that if you feel you would like some more information, we're available there for you. We have a monthly newsletter that can get you started in this. It basically reviews the economy, it reviews all of the news that's going on and the sectors, and it also includes a pre-selected portfolio of stocks, large cap dividend paying stocks that are very good solid investments from my viewpoint. And it gives you the earnings updates on those stocks every month. So if you want a little help to get started in this venture of building your wealth, then check our website, bowoodpartners.com, and you can register for our newsletter and get some individual help. But in any case, check our website. Send me an email every once in a while. I would love to be involved in your investing future. Good luck to you, and please keep in touch.